typical Wall Street, rolled it up into a product and are selling it and making money off of it.
Yep,
So,
exactly.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me.
Oh, you didn't ask me. What's new with you, Cory?
I mixed it up this week. You know, what is new? Over the holiday weekend, over Independence Day, my brother visited from Chicago and my aunt from St. Louis. So they came up and met the baby. So lots of family time. And I observed that the newborn was unfazed by the fireworks, Jake, around the 4th of July. But I cannot say the same for the dog.
Well, good. I'm glad the baby had her first 4th of July and it wasn't too terrifying for her. And you're right, Einstein. I was just bragging to my dad I was like, oh, he's fine. Fireworks don't bother him.
Yeah.
Sure enough, that guy did not have a good night on 4th of July. But the new house is more soundproof than the other house. So again, with us, lots of golf, as everybody knows. I am also been working on getting our new home furnished and decorated and painted and wallpapered. And it's getting close, Cory. We're still missing a dining room table, still missing some chairs, I think, or tables or who knows. But it's getting a lot closer. It's a lot cooler. And Rachel and I are really enjoying it. So, and again, I don't know if I mentioned this on the show, but I've seen her outside more in this house in 6 months than probably 8 years at the previous house. And I love to see that because my wife loves being outside. So I'm glad she's enjoying our big backyard now with our dog.
Excellent. I'm glad to hear it. I'm glad to hear it's coming along. Look forward to seeing it and looking forward to our lunch here today, Jake.
All right. So before I go into today's topics, Cory, I wanted to just reaffirm one of our commitments that we take very seriously with our clients. And I may be a little bit grumpy about this, but in today's environment, Cory, I think customer service has completely gone by the wayside. And I don't know if it's the age of the digital era that I think that people hide behind their keyboards so they can be unresponsive and rude and just give crappy service because they don't actually have to answer to anybody anymore because it's all via email or text or whatever. So our commitment, though, to our clients, Cory, is if any client emails service@falconwealthadvisors.com, they can expect a response from a team member within 24-hour business hours, right? So if they email it on a Saturday, they'll hear back by Monday. If they email it on a Tuesday, they'll hear back by Wednesday. Granted, there's no weird holiday in the middle of the week. And we do that because we think it's very important when our clients entrust us to help guide them with their retirement planning, financial planning, tax planning, and investments, that they get replied to in an appropriate time frame. I don't know how many times, Cory, that I've emailed somebody or some company and it's crickets. It's nothing. Sometimes I don't even hear back, And so we take that very seriously. And I want our clients to understand that we do hold that commitment so highly regarded, Cory, that if you don't get a response within 24 business hours, we will take you to lunch as an apology. So again, I want our clients to continue to hold us accountable for that. If you've emailed that group and didn't hear a response within 24 business hours, let us know, and we'll certainly take you to lunch as an apology. Anything you want to add to that, Cory?
It reminds me, Jake, of something that I'm sure that we've talked about on the show before. But what that is that you and I, and our team, we cannot control what the market does. But what we can control is how educated we are and the level of service that we provide to our clients. And that's why we do this. And that's why it's important. And that's why we take it seriously.
Right. Good point, Cory. You're exactly right. That is something we can control. So why don't we do it? And a world full of uncontrollable things. Very good. And then a quick plug to our show. Thank you so much to all of our subscribers. Please like and share our content. We still are open to taking questions from our audience. So if you have a question, a topic, a subject, anything you would like me and Cory to discuss or debate live on Upticks, please email Luke at falconwealthadvisors.com, and Luke will make sure that we talk about your topic live on our show. All right, with that, Cory, take us away.
Play ball. All right, Jake, when performance doesn't even predict past performance. When past performance doesn't even predict past performance.
Yeah, a little tongue twister for you
It
there,
is.
Cory. So the Dow Jones Industrial Average was created in 1896. Okay, a long time ago, Cory. And it uses prices of stocks to determine the weighting of the index, which is crazy to me, right? So just to give you an example, Cory, if you are XYZ company and your share price is $400 and you're in the Dow, and ABC company's share price is $10, even though ABC company might be a bigger, better run company or whatever, that higher share price company has more weighting. And so the article was a good point that maybe they're using 1896 math to determine this index. But in today's world, it actually makes little to no sense. And I get it. When they started tracking the Dow, it made sense because the dispersion, I'm sure, back then wasn't as wide as it is today, perhaps. And things didn't get crazy for inflation. And so I'm sure stock prices probably were more indicative of actual size of company. But today, that's certainly not the case. And so I would just want to encourage our audience that you really shouldn't be looking at the Dow as any type of barometer or indicator of what's going on, because the way that it's weighted is so weird. It's really hard to really take any weight in or make that hold any true ground because of that. And in fact, Cory, the S&P 500 is just as bad, in my opinion. They use market cap. So again, that's a little more accurate, I guess. You take all of the shares outstanding times the share price. But again, that still has gone way top heavy on the tech side. And so even using the S&P 500 as a true market indicator today isn't very accurate at all. And I'll tell you what matters. You know what matters?
Your performance and your financial plan.
Exactly. Good answer.
Your target.
Exactly. Your financial plan matters, your target return, and your investment return. That's what matters. And so I wanted to bring that up. And then there's a second part to this article, Cory. And it's an issue I have with investment marketing. And this article really did a good job of shining a light on it, is that it says many mutual funds out there will use hypothetical rate of returns and publish that, which is stupid to do that. And the applause is for don't encourage that behavior. You need to understand that if anybody, an advisor, a mutual fund, is using hypothetical performance to try to get you to buy their fund or pay for their investment advisor services, then you need to politely walk away or you need to ignore it. You need to say, don't waste your time, because what really matters, and again, I want to continue on this, what really matters is real world performance. How did you really perform for real clients in real market environments? And now, quick disclosure here, though, past performance is no guarantee or indicative of future results. So even if somebody has the best track record in the world, going back the last 100 years, it doesn't mean they're going to perform that way in the future. So again, the article, when past performance doesn't really predict or whatever past performance, is because people use hypothetical return. What do you think about this, Cory? Isn't it crazy?
Are they talking about using hypothetical returns looking backwards or forward or both?
Backwards. So they said that a mutual fund, when they're launching, like let's say a mutual fund's launching in 2024, and they say, hey, Cory, we have found the best strategy ever. And we back tested it, is what they're talking about. So we back tested our strategy of how it would have performed in these market cycles. And this is how great it did. But my point is, anybody can back test and make something look good.
Yeah. Well, it's kind of like, you know what? Do it. Show me the real performance. Don't show me the hypothetical performance, to your point. Because it's kind of like, Jake, the way I see it is, if you and I showed prospective clients hypothetical performance, that's effectively saying, here, let me show you how your accounts would have performed if they were invested differently than the way we're going to actually invest them. Like it just doesn't make any sense. It's kind of like any hypothetical scenarios don't matter unless that's the way that my money was invested during that time period, right?
Right. Yeah, exactly. So that's what's so frustrating to me. And the other argument is like, well, if this is so good, why weren't you doing it?
Always, always. And why are you telling me about it?
Yeah, yeah, exactly. So again, caution to our audience.
Yeah.
If you're out there getting pitched by someone, ask them, is this real performance or is this a hypothetical illustration? Hypotheticals hogwash. You know what we do, Cory, with our potential new clients is we'll actually show them real performance. Now, again, we make it very clear this isn't going to predict how you're going to do in the future, but we want to show you how we actually did for a real client. And to me, that's the only way to look at it. But you got to remember that's still no predictor of the future.
That's right. But it's
All right,
better
good.
than
Let's move on.
hypothetical.
What's that?
Better than hypothetical.
Right, exactly.
My
It's as
opinion.
good as you can do.
That's right.
So, all right, good. All right, Cory, on to the next one here. You snuck a chart back in the show. So one chart from Strategas, quarterly review in charts. All right,
Yes.
what do you got here?
I was very explicit, Jake, in stating that this was one chart because there was about 60 in this slide deck, and I didn't want to go over all of those. But I just wanted to see what you thought about this because I found this really interesting. It just kind of stood out to me. And I know not everybody's watching this, so if you're listening at home, the chart here is really just highlighting the number of companies that are listed on U.S. exchanges, so publicly traded companies, and also private equity assets under management. And this data is going back 20 to 30 years. And what's interesting is the de-equitization, which is what this is talking about, is basically the shrinking of the number of public companies over the last couple of decades and how much private equity and private equity assets under management have really continued to grow. So I just wanted to I was curious, Jake, what's your take on this? What do you make of the shrinking number of public companies and the growing number of private companies?
Did the article tell you, is the shrinking of public companies because of consolidation or mergers and acquisitions? Is it because companies going out of business, or is it because companies went private? Maybe it's all of the above.
It's literally the number of companies that are listed on the exchanges is all the context that I have here.
Okay, so I'm assuming that's because of mergers or acquisitions, companies going out of business, or being delisted and turning private, right? And so I think it's fascinating. The other piece of the chart, the increase in private equity or private companies, and I have no crystal ball, Cory. You and I have talked about this, I think, before, though. I think private equity is headed towards a bubble because it's this sexy thing that, was just kind of reserved for the uber wealthy for a while, and now it's becoming more and more and more mainstream. And the problem I have with private equity is that you don't really get the rules of auditing and transparency and liquidity that a public market gets. And so it's very easy to make a private company, in my opinion, look more attractive than it probably really is. So I'm worried that could be a bubble, just like the .com bubble, right? Pets.com and all these companies were popping up out of nowhere just because they had a URL or internet address didn't mean they were good companies. And so I feel like that's what's happening in the private equity world. And again, I don't know. I could be completely wrong. I'm not saying I can predict the future. I think it's okay that there's less publicly traded companies because I don't think every company deserves to be publicly listed. So I actually am okay with that shrinking, but I am more concerned about private companies increasing, thinking that is going to be a bubble that bursts. What do you think?
Yeah, that's good. My take on it was that part of the reason, in addition to everything that you described about the shrinking public companies, is that with the sort of proliferation of private markets over the last couple of decades, there's just less of a need for some companies to go public in the first place. So like I'm sure there's private companies today that may have IPO'd 10 or 20 years ago, but it makes more sense for them to stay private today. But I do think in terms of the observable facts here in public versus private markets, right? We do know that private markets are less efficient, less liquid, more restrictive in terms of who has access to them, and subject to less regulatory scrutiny, which can lead to governance issues and financial reporting issues, like you said. So, my take around all of this was that if the market is less efficient, less liquid, less people have access to it, there's less regulatory scrutiny, but the returns look great. Okay, that's one thing, but it's kind of like, what an investment. It's just like our house, Jake. It's just like my house. Like it really doesn't matter what the value of my home on paper is until the day that I go to sell it. And at least in a public market, we know when we can liquidate investments and get cash for clients or for ourselves, or for, if anybody needs access to liquidity. But private markets, it doesn't always work that way. So I found this fascinating, but I'll be interested to see how much this changes over the next maybe decade or so, in light of interest rates being higher than they were.
Right.
How much of this has been financed through this sort of, very low interest rate environment that we've lived through for the last 15 years. It is interesting how much that lines up with explosion in private equity.
That's a really good point, Cory. Yeah, because money was cheap, borrowing was cheap, so it was easy to, take loans out and drive this up. It will be interesting to see if we have higher rates for longer, what that ultimately does for private equity. That's a really good point that you brought up there, and we'll see.
We don't know yet. We don't have enough data to see how it really plays out.
Yeah. And again, as with all investments, if it sounds too good to be true, it probably is. So don't get caught up in, this private equity deal is making 20% a year and, blah, there's no risk, blah, 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 right? You got to be careful of that stuff. So good.
Yeah, so hypothetical returns and made up returns. Okay. All right, good. But all right, we'll move on, Jake. So is there really a retirement crisis? Most U.S. retirees say they're doing just fine.
Yeah, so this was a much anticipated report that came out by the Retirement Confidence Survey fielded by the Employee Benefit Research Institute and Greenwald Research, Cory.
Got it.
And they found that 71% of retirees said they are confident that they have enough money saved to last the rest of their life. So good for them. That's more than I thought there would be. But it goes on to say 91% said that Social Security is their primary source of retirement income. Now, I don't know if this means, and I think this is what this means, the majority of their income is coming from Social Security.
Yeah, presumably 50% or more, yeah.
Yeah, and so that's not our clients, though, typically. Some of our clients, that is the case. But
yeah.
Most of our clients, I would say Social Security is less than half. When you say?
Yes.
Not all. Not all. It depends. It's
generally, I would agree, yes.
So it makes sense to me, though, right? So, of course, you're going to be confident if Social Security is covering most of your bills. That makes sense. They went also on to say that 65% said they are confident that Social Security will continue to provide benefits despite repeated warnings and potential insolvency. So that's good. I don't like people to be scared about Social Security because I think it is a fixable problem. It's just going to be an unpopular solution to some people. Cory said 70% of respondents said they are confident that Medicare will continue to provide benefits. So that's kind of in line there. This was an interesting one. I want to hear your take on this. 53% of the retirees polled said they thought they would need a nest egg of at least $500,000, but 64% said they hadn't saved that much. So isn't that interesting that half the people said this is what they think they need, but more than half don't think they're going to have that or have enough saved?
But then simultaneously, 71% of them are confident that they have enough money.
It's a weird
How do you reconcile all that?
Yeah, I don't know. And then a quarter of respondents, so 25%, said they would have trouble handling an emergency expense, and many expressed concerns about debt. 36% said that debt is a problem for them, and 23% said that it's significantly impacting their ability to live a comfortable retirement. That was a pretty cool survey. Again, I don't know the details, the sample size, and what part of the country they surveyed people. But what are your thoughts on some of those numbers that I threw at you?
Well, we just commented a moment ago about how some of the data can be a little contradictory, but that's, of course, this is what happens with humans, right? Answering surveys. I do find it interesting, though, that basically 1 in 4 of the retirees surveyed said that debt is significantly impacting their ability to live a comfortable retirement.
Well, here's my take. Good. You're right. That's a lot. Is that a lot to you or not a lot?
Yeah, 1 in 4. I think, well, I guess that's a lot with the context that 71% of these people think that they're confident they have enough money. But then a quarter of them say that debt is significantly impacting their ability to live a comfortable retirement.
Maybe that's those people that aren't confident.
Right there. Maybe we know the percentage, but yeah.
Maybe it is getting reconciled. So my takeaway is, if you're listening or watching to Upticks and any of these things, debt, emergencies, sustaining your lifestyle throughout the rest of your life, Social Security, or Medicare, if any of those bother you, concern you, scare you, the number one thing that I've seen fix that is having a financial plan and updating it regularly and meeting with your friends at Falcon Wealth Advisors. Because yes, we can't control Social Security or Medicare, but having a plan in place, hopefully, will alleviate some of those concerns, because we can run projections and scenarios and look at those things and hopefully calm some of those fears. It's like having a plan in place when a tornado comes, right? Tornadoes are still scary, but if you've got a basement or a safe room or a storm shelter and you've got food and a flashlight and batteries, you've got a plan, hopefully that calms it. Same thing with buildings, Cory. You and I have worked in big buildings our whole time we've been working together, right? And there's emergency exits. There's fire safety protocol. So yeah, I wouldn't like it if our building caught on fire right now, but I know where the exit is, right? And so that's a plan. That's a plan for an emergency. So again, having a well thought out, updated, reviewed financial plan can hopefully mitigate some of these fears and some of these risks. That's what I see.
And I would also add to that, Jake, that without the plan that you're updating regularly, and if you have concerns or fears or worries about this, there's no magic way that those worries are just going to be, massaged. Like if we live in a 24/7, 365 global world now that's connected, there is a myriad of issues to worry about on any given day. If you want to go looking for them, you can find them, right? But the question is, what are you going to do about it, right? What can you actually control? And I think the same thing is true here. If somebody's worried about debt and then retirement in their financial plan, and they're worried about the impact that it has, without updating a financial plan and having a plan, you're just going to keep on worrying.
Right. Good one. All right, good. Let's go on to the next one here, Cory.
Yes.
These hot new funds are boomer candy for retirees.
This is from the Wall Street Journal, and it talked about exchange-traded funds, or ETFs, that use derivatives or options, have taken in over $31 billion, Jake, in the last 12 months. So ETFs that use options have taken in over $31 billion in the last year. The funds often sell options to generate income, or there's buffer funds, Jake, that claim to guard against losses to a point while limiting gains. The gains are capped, and the fees on these funds can be chunky. But I thought it was interesting that there was a quote in this article that said that boomers can't give up their stocks because of FOMO, or the fear of missing out. I thought that was really interesting, that basically this article was making the argument, or not argument, it was making the case that all of the money that's flowed into these funds is a lot of people that are baby boomers and retirees who have made a lot of money invested in stocks, and they are concerned about the level of risk that they're taking, but they don't want to give up their equity exposure because it's how they made a lot of money. So that is theoretically where these funds come in, to provide upside, but also to protect downside, which again, the whole too good to be true piece that you mentioned earlier, Jake, really kind of resonated for me when I was reading this article. But I just had some questions about this that I thought that I just noted here I wanted to talk about. If me or you or anybody else, Jake, could go and buy an ETF that's using options and all this money's flowed into these products in the last 12 months, my questions are, how are these funds going to operate during periods of extreme market stress? And if the adoption of new rules in late 2020 is what made it easier for asset managers to use options, we just don't have enough data yet for people to be pouring $31 billion into these funds, in my opinion. And how long do you need to own one of these things for it to really work? And do you want to ultimately own something that the Wall Street Journal is calling boomer candy? It's really the question. But I just think this is interesting, Jay, because I figured you might have some thoughts around exchange-traded funds that use options on individual stock positions and how much money is flowing into those and what people may or may not be aware of.
Now, did the article say, did it go into the depth? Are these funds using options the way we use funds for clients, or is it different strategies? Did they talk about the strategies?
One of them was a covered call strategy, effectively, where it's selling options to generate income or premiums. But these buffer funds too, there were several different ones that were highlighted. But the ones that really I found interesting, and I understand why this probably sounds attractive, is these funds where you're invested in stocks, they're using options, your downside is limited despite the fact that you're investing in these stocks, but your upside is capped, which sounds just like a structured product, right? It's another type of vehicle. So the point in all of this is just that when there's something new and exciting, and that much money flows into it in such a short period of time, there's something to be said for a tried and true strategy with actual data points over a period of time to collect.
Right. And I like options for approved clients. I don't like options rolled up in a product, though, because the same reason I don't like bonds rolled up in a product is my thinking from this. And so options are very tricky. They're very sophisticated. There is not only a price, but a time associated with an option. So just like a bond has a maturity date and a price. So my issue is with these ETFs, Cory, the money's flowing in and flowing out. And some of these option contracts may need to be liquidated ahead of their expiration time. So again, I don't like lumping in clients with thousands of other clients in such a sophisticated strategy. When we trade options for clients, it's at the account level so that we can manage that. So if a client needs to pull out money or add money or do something, we can manage that for that one client. We don't have to blow up every other position for all our other clients. And so I think, sadly, it's another way for Wall Street to make money, and that's what's happening here. And so they packaged up these options as more clients or individuals are getting sophisticated and understanding how options work. So typical Wall Street, rolled it up into a product and are selling it and making money off of it.
Yep,
So
exactly.
I think, though, the problem is that investors probably don't know what they're really risking.
Of course.
So you have to be very careful. Options that can be a useful benefit to a portfolio. They can be, but they also could hurt you. So you've got to be very careful. If you're going to buy one of these index funds, you better read that prospectus and understand, like you said, what your upside potential is and what your downside potential is before you put a penny in one of these things. Because
Yes.
I would hate to hear somebody losing significant amount of money and they had no idea. And you hear about that all the time. They have no idea what they're doing and they lose money. So.
Yeah, it does. Do you remember, Jake, I think it was early 2018, it was XIV, which was the VIX, the volatility index backwards. It was an exchange traded note that was just a really popular trade that a bunch of money poured into. And the thing went to it got like liquidated almost overnight. Like basically the whole short volatility trade just blew up. And literally billions of dollars that poured into this fund evaporated.
Yeah, and it can happen.
And I'm sure somebody that bought it didn't know that could happen, right?
Yeah.
So anyhow.
All right, good. We got time for one more, Cory.
All right, Jake, do you want to pay cash? That will cost you extra.
Yeah, have you heard of this? So places like Yankee Stadium, Cory, amusement parks, are requiring people to go to reverse ATMs they have on site there. You basically have to put your cash in a machine, and it spits out an ATM card, I guess. And there's a fee. There's a fee to do it. So you want to go Yankee Stadium, buy a hot dog, and you want to give them a $20 bill, they don't take it. They say you got to go to the reverse ATM, turn your cash into a card, and that machine charges you a fee.
Go stick your quarters in and it'll give you a plastic card. It's like the opposite, yeah.
It's crazy. And also some people choose to, that people get paid in cash or whatever. They're paying their utility bills in cash. Those people have to do the same and often have to pay a fee. So my question to you is, what do you think about this? Should people have to pay a fee to turn cash into a card to pay somebody?
No. Why do people have to turn cash into a card to pay for somebody? Like, why can't Yankee Stadium take a $20 bill? Like,
I guess it's for security.
I don't expect you to know the answer.
I guess it's probably easier for Yankee Stadium. Maybe there's theft, skimming, easier for them to track cash. I mean, not cash, but digital, right?
Of course.
So, think about it though, really. If you owned a stadium, think about how many games the Yankees are playing, 80 games, and you have to worry about having enough quarters, pennies, nickels, dimes, 20s, 10s to all those hot dog and vending machine, like concessions. Like, are you typing something?
What's that?
Are you typing something?
No.
Were you typing something?
I clicked on a different tab.
I was wondering. So my point is, I get it. I get it from Yankee Stadium's perspective. I don't like that you have to pay a fee to do it. Some places like, which I don't agree with these types of companies. I forget what they called it. Basically, a high interest loan company. They make their people pay with card, but they don't charge a fee for them to turn their cash into a card or digital. So I believe it's the company's choice. So my point is, Yankee Stadium could make it free. They could eat that cost, right?
Right.
I agree. In America, I feel like cash should be accepted everywhere, but it's not necessarily. I mean, we don't take cash, to be fair. So we also don't make people go get an ATM card and have to pay a fee for it. But
we don't. We can send the money to their bank account. But yes, I think that it is. I don't know. You know, my perspective on this, though, Jake, is just that I do get it and I understand it. But, you know, not everybody has bank accounts and investment accounts and everything else that's involved. And I realize that this is a card, but it just, you know, if you can't go somewhere and pay for something with cash, you know, what I understand in a big place like an amusement park or a stadium, but it just concerns me that when something like this becomes commonplace at Yankee Stadium or at Worlds of Fun, that all of a sudden it becomes commonplace elsewhere and people can't use cash anymore. And then every transaction is tracked so digitally. But what about people, frankly, that just don't have very much money? They don't have access to multiple accounts. Some people don't even have bank accounts, right? People that come to this country from somewhere else, they can't use cash anymore. Like, I don't know. That's just my take. But if we're going to print dollars, if we're going to keep circulation, if we're going to keep currency in circulation, people should be able to use it.
So you think the country should force Yankee Stadium to take cash? Because I think they did this in some states at a state level. I think the state legislator said it's illegal to not take cash. And I think there's a bill that didn't get passed at the federal level. So is that what you're suggesting? I'm not saying it's right or wrong. I'm just curious. You're saying they should force companies to take cash?
I think that retail businesses, I think that as long as there is currency that is in circulation, places should need to take it. I don't know what exactly that looks like, but
I think you're hurting. I agree with you. I think you're hurting the wrong people. Like you said, like, what about the bartender or the waitress or waiter?
Yes.
They got cash and they want to spend it and you won't take it. I think the company should pay for it to be reversed. So like if Yankee Stadium doesn't want to take cash because it's not convenient for Yankee Stadium, then I think they should provide these ATMs and not charge a fee for it.
I'm good with that.
That's what I think should happen. I get it. I get why it's better for Yankee Stadium, but I don't think they should hurt their consumer.
Yeah. But the reality is Yankee Stadium probably knows that their consumers are going to come there and spend money anyway.
Well, so how about this one?
They can do what they want to make it easier.
I think this was at an amusement park. Somebody put $20 in on their card and they spent $15. And then they realized, Cory, the card was only good at that place. So they went and spent $5 more on something because it was going to be useless.
That's the design. It's like the Dave. It's
like what?
I was going to say it's like the Dave and Buster's bucks, right? Like you can turn money into Dave and Buster's bucks, but you can only spend those bucks at Dave and Buster's.
Yeah, so that's a racket. I don't agree with that at all.
Yeah, I get why they do it. That way you're gonna spend the money. But anyway, it's just
that's messed up.
What's interesting about all this, though, Yankee Stadium, Dave and Buster's, mutual funds, ETFs, products, everything we've talked about here. Interestingly, a theme that stuck out to me from today's show, Jake, is buyer beware, right?
Yeah.
Buyer beware.
That's good. That's good. It's a good place to end it today's episode. Buyer beware. Be an informed consumer. You got to be, there's been swindlers and hustlers since there's been money. So don't be fooled. Know what's going on. Check into things. And good one, Cory. With that, we'll wrap it up. Good luck with the baby. Thank you all for tuning in as always, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.